Hey traders, in this video we're going to be looking at the stair-step trading strategy, which is a low risk, high reward setup that you can add to your tool belt as a trader. So with this trading strategy, we're going to utilize the pattern of a higher low every single candlestick or a lower high every single candlestick for a significant number in a row. And when that pattern breaks, it is our signal to act upon. It's a style of top fishing or bottom fishing, which means we're playing off of a clear support or resistance level that is right nearby. Because of that, it has low risk, and when the trade works out, it has higher reward than that risk. That being said, because of the inverse relationship between risk and reward, it means there's going to be a good number of stop outs. But because the risk is so low, it only takes one winner that can offset multiple losers. So let's break down the details of this trading strategy a little bit more. We're going to be applying all of this information in an example that we're going to look at next, but we're going to go over position sizing and calculating our risk and reward and identifying where to put our stop loss. And then we're going to have our targets on where we want to exit and determine which of these setups do we want to be taking. So here's an example of this trade that I took just this past week. This is IWM on the 5-minute time frame. And again, we call it a stair step because it's a higher low every single candle. For me personally, I like to see 8 to 10 candles or more in a row if I'm going to consider this trading style. But depending on whether you want to be aggressive or conservative, you could use less candles for your signal, or you could be picky and use a lot more candles for your signal. So we'll break down aggressive versus conservative styles here in just a minute. But for this example, we had a higher low every single candle for over 15 candles on the 5-minute time frame. And if I want to have probabilities in my favor, I want to ensure that the longer term time frame is potentially favoring a pullback here, because the bulls are in complete control of the short term. And if I'm looking to go short on the signal of a higher low every single candle being lost, I'm playing against short-term momentum, but I want to ensure that I'm trading with longer-term momentum. So IWM at that point in time on the daily time frame had just gone from being in an uptrend with higher lows and higher highs. We had pulled back significantly on the daily. We lost the higher low pattern, and so we can anticipate that because of this pullback, the size of this pullback, and because we lost the daily uptrend, that we can anticipate the next time we bounce, we're scouting a daily lower high to be the most likely scenario. Now, I can't look at the 5-minute time frame here and say when we lose this 5-minute higher low every candle pattern, we're probably setting our daily lower high. That's a bit of a stretch. But I do know that the longer term time frame of a daily lower high is likely to happen sometime within the next few days. Maybe I can luck out and nail the top of that move. So the way that the trade is signaled is simply just losing the pattern of a higher low every single candle. And again, it works in the other direction as well. And we'll look at some other examples. But in this example, I had it set up that I was going to be looking for a loss of the higher low every candle pattern and entering short. So this is me in the chat room getting ready for this trade, going to top fish IWM when the higher low every 5-minute candle pattern breaks. And I'm going to look to cover half to try for a break even risk. So that was at 10:49 a.m. and that was pretty much right about here. So it took another 15 minutes of waiting patiently because we put in another higher low every single candle for another 3 candles. So that pattern was lost at 226.10. So as soon as 226.10 breaks, and I'm not waiting for candles to close, I'm acting as soon as the price breaks. So as soon as 226.10 breaks, I'm entering short. And at that point in time, if I trigger right away, let's just say I get filled short at 226.09. So I am 20 cents under the high of the day at that point, and my stop loss is now going to instantly be placed right away above that level. And I want to give a little bit of wiggle room because the last thing I want to do is see that price break by 5 pennies and then we get further pullback. So looking at this pattern, I can say, or I should say this setup, I can say, okay, well, I'm going to put my stop at 226.41. And I personally always go over a psychological level because sometimes we will reject from nice round numbers. And so 226.40 or 226.41 doesn't make any difference to me as far as the trade is concerned. So I will always just go 1 penny over that nice psychological round number. So my stop out is 226.41 and my entry is 226.09. So my risk on this trade is 32 cents. So I will lose 32 cents on IWM if we see continuation. And I have to put this stop in very quickly because, again, I am trading against short-term momentum. And this is what I'm talking about with low risk and high reward. My risk is 32 cents, which is certainly low risk. But if we form a 5-minute bull flag and keep going, I'm now in the red. So again, I want to stop out. As soon as a 5-minute bull flag is confirmed, that tells me, nope, you're wrong. The top has not been set. We're not seeing hourly consolidation, which was a bit overdue. We're not seeing 15-minute, even 5-minute consolidation. We were due for consolidation on all these time frames, but I have to protect against the possibility that we keep going. So risk is 32. What is my potential reward? For me personally, I love this trading style to go risk-free as soon as possible. So let's just say I enter a 100 share position, and as soon as we drop down to where I can be risk-free, I sell half of my position. So what does risk-free mean? Well, I have 32 cent risk. So if we drop down 32 cents from my entry of 226.09, then that means I am risk-free. So as soon as we drop down to that point, I exit half of that position. And that is somewhere in the 225.70s. So 225.70s hits very quickly. We have the pattern break. This looks like it could be a possible bull flag. We fail the high and we drop down to where I exit half of my position. So now my break even stays the same, or my stop loss, I should say, 226.41, but I'm in half the position size and I cannot lose on this trade. Worst case scenario, we see continuation after a quick higher low is set and I stop out break even and I move on to the next trade. And from there, I can do two things. I can sell at a potential target, or I can just wait, and if I stop out, then I stop out break even, and I can just let the trade play out all day. So the way that I personally did it is we saw this pretty sizable pullback, and at this point in time, I was about to leave the computer for a couple hours, and I just wanted to lock in this winner. So I exited the second half of my position on this pullback in the 225.30s. And so that means I ended up with $1 gain on half of my position, because again, break even at that point, 226.41. Let's just say I exited at 225.41. I made $1 on half of my position, and my risk on that half a position was nothing. Originally, my risk on that position was 32 cents. So the reward was more than the risk, but in certain instances, for example, had I just let this play out, my reward could have been much more significant than what my risk ended up being. So it was a little bit of a real life scenario as far as I had an appointment to catch for the reason that I exited, but I could have multiple targets. I could say, okay, well, I know that we have bulls in control in the short term, but I'm scouting a 15-minute higher low. And I actually said as I left this trade, I have to leave now, but otherwise I would be targeting EMA 12 support as my exit. Or I could be a little bit more hopeful and hope that hourly consolidation is about to get underway. And it did end up seeing a pretty notable pullback. So long story short, we ended up pulling back $2 and more than $2 from that level. And it just determines on how aggressive or conservative I want to be with taking my profit as far as when do I stop out. If I wanted to be really patient, I could still be in this trade right now. I would have had some overnight risk where if we gap up open above my stop level, then I would have taken on more risk than I ideally wanted to. But we never got back over 226.41, and here we are now down in the 221s. So again, there are many different ways in terms of how you can let these trades play out as far as how much potential reward there is. The key thing for me is keeping the risk small on the initial trade and keeping, or I should say moving to break even risk-free as soon as possible. So what determines our position size? How did I know what size entry, or I should say what size position to take on that initial entry? Well, I personally have a dollar amount that I am willing to lose each day. And if as soon as I hit that dollar loss level, then I'm done for the day, because the last thing I want to do is compound mistakes and go on tilt essentially and end up with a week's worth of losses because I lost control for an hour of my emotions. So I want to have a safeguard against that. So I can say, okay, well, the most that I'm going to risk on any given day is $500. And so that means if I'm entering at 226.09 and my stop is 226.41, then I need to take a dollar amount position size that is less than a $500 risk. So I could take 1,000 share position, and that risk would be $320. 32 cents if I would have stopped out, and that is within my risk tolerance. And then if I sell half, 500 shares sold, my break even is now 226.41, and if I exited 225.41, I then make $500, and maybe that's my day maker level. So I determine the size of my position based on the dollar risk, and again, assuming instantly that I am going to stop out of this trade. As soon as I enter, I am placing my stop and saying, I know exactly what I am going to lose on this trade if I am wrong. And because it is fighting against short-term momentum, like I said, there will be plenty of instances where you do stop out very quickly. But we just have to ensure that the potential reward is greater than that risk. And there are often times where we get plenty of follow-through for it to be worthwhile. So here's another example, but this is a longer term time frame. Say you're a swing trader, you don't care about the 5-minute chart. So here's AMC on the weekly. We have a big time breakout, and there's really actually two ways this worked. We had a higher low every single candle for 6 candles in a row, and then once that broke, that marked our top. But I was looking at it from the perspective of a lower high every single candle for 8 candles. We know the most likely scenario is a higher low compared to where we came from. We know the most likely scenario after massive volatility is an equilibrium as one of our most common trading patterns. And we see the pattern of a lower high every single candle break. Now, not all setups are created equal. So just as an example, let's say that the bull break had occurred after this big green candle. Right here, we have a double top of 46.55, still a lower high every candle. And let's just say this little candle here, let's say that broke bull. That's a trade that I skip. Why am I skipping that trade? Because by the time that trigger occurs for me to be in the trade at 46.55, we're pretty extended off that low. Look at the amount of risk. That low is 31.15. So if my trigger is 46, I'm taking on $15 of risk. Is the reward going to be worth it? Are we going to see more than $15 to the upside? Well, if it's an equilibrium, then I'm anticipating the most likely scenario is a lower high and tightening range. So I don't like the risk being that large. We're too far away from my stop level for me to like that trade. And it also tells me that if that bull break were to take place, we're probably pretty extended on some of the shorter term time frames. So I want things to be as tight as possible, nice and condensed, and for the trigger to be as close to the low of support as possible to keep that risk very small. In this instance, we had a weekly inside bar that broke bull, and that bull break took place at 37.16. So 37.16 breaks, I get triggered into the trade, and as soon as I do, my stop goes under the low of 28.91 at that point in time. It's still a decent amount of risk. That's $8.25 or so to the downside before I stop out. So I have to use a position size where $8.25 of risk is acceptable, and that is, almost 20% of a drop. So that means I'm using a small position size. The bull move has seen follow through at this point. We're back in a pattern of a higher low every single candle, 5 candles in a row. And again, I can use my break free scenario and sell half of my position, $8.25 to the upside, which would be in the 45s. So I would have exited on this move here, on this candle, and maybe I'm still in half my position. Or maybe I just want to lock in that gain and say, okay, well, I'm anticipating a weekly lower high as the most likely scenario, and I don't want to swing trade this very volatile name for months on end. So maybe I just enter on the bull break at 37.16. Maybe my target is for the whole position, just that $8.25 move to the upside, and I sell everything. Again, that's where things can be opened up as far as customization, essentially, to your style as a trader. How much risk, how much reward do you want to take on? Where are you going to be aggressive? Where are you going to be more patient? So that brings us on to the next slide, comparing aggressive versus conservative styles of this stair-step strategy. So whenever I'm getting ready to take a trade, I always want to determine, am I looking to be aggressive or conservative on this trade? Because that determines how I'm going to shape things as far as my entries, where my stop is going to go, what risk I'm going to take on, and where my target is. So if I want to be aggressive in this strategy, maybe I don't need as many candles in a row if I'm going to act on that signal. Maybe I only need 6 candles and more. Maybe the bigger picture is not important. Let's say we're at blue sky breakout all-time highs. and we just put in a higher low every single daily candle for a couple weeks. I know the most likely scenario is not a lower high because we're in blue sky breakout. I know that when we start daily consolidation, bulls are going to be aggressively buying dips. But if I want to be real aggressive, I'm still going to act on that signal. Maybe I'm quicker taking profit. Maybe I'm just treating it as a little short-term flip and I'm in and out and I don't break up my positions. All or nothing, meaning I'm not exiting partial positions and lowering my risk. Maybe I just take profit into the small initial move, maybe more of a scalping mindset as far as how quick I'm in and out. If I want to be conservative here, and if I only want to use this trading strategy when the odds and the probabilities are very high, then I'm being a lot more picky. Maybe an aggressive trader sees this trade setup take place a couple times a day, or maybe a few times a week. If I'm being real conservative, I'm going to make my criteria for entry, and I can write down this specific criteria and make this as automated a system as possible. And maybe I'm so picky that this trade only shows up for me maybe once every few weeks. I can be waiting for at least 10 candles in a row if I'm going to have any interest in this trading style. I have to ensure that it aligns with the most likely scenario of a longer term time frame. Maybe because of that, I let this trade play out longer. And again, scaling out is a way to let some of that position attempt to play out longer. So maybe I'm being more patient because I've been waiting a while for this setup to present itself. So again, it depends on you as the individual, but there are ways that you can establish your clear criteria and again, eliminate as much emotion as possible and make it as regimented an if-then scenario. If it's not 10 candles in a row, then I am not taking this trade. So as we wrap it up here, just want to give you a couple examples that have not played out yet. It's early September 2021, and this is something that you can go back and look at and see how it would have played out. So here's DKNG monthly time frame. I see the all-time high. I see a base of support established. And in this scenario, I'm anticipating a monthly lower high compared to 74.38 is the most likely scenario. And I'm looking for a tightening range on the monthly time frame. The daily chart just went through a stair-step pattern where we put in a higher low every single day for 14 days in a row. You can see we formed an inside bar, we got real tight, and we just broke that pattern this past Friday. The signal to get in was a break of 62.82, and again, I'm entering bearish now, and my stop goes over 64.58. So roughly, my risk is going to be about $1.70 some cents. So I need a pullback, my trigger at 62.82, I need a pullback to about $60 if this is, no, less than that, $61 if this is going to be a trade where I can exit half and then be risk-free. So let's see how much pullback we get from here. Let's see if the bulls quickly set a bull flag and see continuation and stop this trade out. And the best case scenario for bulls here would be that this daily consolidation eventually results in the monthly lower high being set and a more notable pullback. We would need a whole lot of bear follow through for that to be the case. We would need a few more days of downside here. We would eventually need to confirm a daily downtrend. So again, that's looking real bigger picture. And maybe I say to myself, okay, I'm going to make this attempt at a monthly lower high. I'm going to exit half and get risk-free as soon as I can. And then I'm going to hold it, and I'm either going to get stopped out break even, or I'm going to see a pullback of 20% for that monthly consolidation. And again, that's me being really picky as far as how much of a reward I am going for, but that's a possible scenario. Another one, SPY on the monthly chart, higher low every single monthly candle for the last 11 in a row. Let's keep an eye on this pattern and when it breaks and how much pullback we get from that break taking place. And here was just an example back here in 2016 where we had the pattern of a higher low every single month, and that pattern ended up intact for 13 or 14 months. And when it broke, again, we didn't see a ton of follow through. So I have to be, ideally, for me personally, taking partial profit in case it is a bull flag, because the last thing I want to do is keep eating a bunch of losses. So as soon as I can get risk-free playing against the momentum, the better. But this would not have been an ideal example because we're in an uptrend here on the monthly, weekly, and daily time frame. So if I want to be a conservative trader on this style and really picky, I have to ensure that a longer term time frame is aligning with the most likely scenario. Feel free to ask any questions. I appreciate you watching.